A balance sheet is a financial statement that details the assets, liabilities, and net worth of an individual or a company. The three most common types are the bank account balance sheet, the accounting balance sheet, and the personal balance sheet. All three types have different purposes in understanding your finances better. The first step to improving your career and business is to make sure you understand what they are. If you want to know more tips like this, subscribe for weekly videos and turn on the notification bell so you're the first to be informed. What is a balance sheet? A company's balance sheet is a financial statement that displays the assets, liabilities, and shareholder equity of a firm at a given moment in time. Balance sheets are essential for computing an investor's return on investment and assessing a firm's capital structure. In a nutshell, the balance sheet is a financial statement that depicts a company's assets, liabilities, and equity. Balance sheets may be used in conjunction with other vital financial statements to perform fundamental analysis or compute financial ratios. What is the purpose of the balance sheet? A balance sheet provides an overview summary of a business at a given point in time. The term snapshot of a company's financial position is often used. Depending on the audience viewing a company's financial statements, they may have two very distinct purposes. This is the process by which a company's internal balance sheet is utilized to obtain information on whether it's succeeding or failing. Internal decision makers may change their policies on how they do things based on this data. They might try to make more mistakes or focus on new ideas. When an outsider looks at your company's balance sheet, it's intended to provide an insight into the business's resources and how they were funded. Investors may use the information in a company's balance sheet to calculate important metrics like liquidity, profitability, and debt-to-equity ratio based on this knowledge. On the other hand, outside auditors may use a balance sheet to guarantee that a firm complies with any reporting regulation it is subject to. A balance sheet reveals data as of a certain date. It does not, however, reveal information about the future. A balance sheet is inherently based on past facts because it communicates information as of a specific date. While investors and stakeholders may utilize a balance sheet to project future performance, past success is no guarantee of future outcomes. The following accounting equation is followed in the balance sheet, with the assets on one side and liabilities plus shareholder equity on the other. Assets equals liabilities plus shareholders' equity. This formula is simple to comprehend. That's because a firm must finance all of its assets by borrowing money, taking on liabilities, or taking it from investors, issuing share capital. So what's in a balance sheet? The balance sheet is a set of financial statements that indicates the current condition of an organization. Although the structure may vary by industry, it generally includes three primary components: assets, liabilities, and shareholder equity. Current assets. The assets include both liquid assets, those you can convert quickly into cash, and fixed assets, also called non-liquid assets. Fixed assets are items of value that you cannot rapidly convert into money, such as real estate, a corporate office building, or equipment in use. Current assets are things that a company thinks it can convert into cash within a year. These include cash and cash equivalents, inventory, accounts receivable, marketable securities, and prepaid expenses. There are also intangible assets, sometimes known as non-current assets, and long-term investments that provide value to the company even though they aren't physical. Long-term investments that aren't expected to be converted into cash in the near term, such as patents, buildings and land, IP, intellectual property, brands, goodwill, trademarks. When you combine all of these, you will reach the total assets of the balance sheet. Liabilities. Liabilities are the debts of your business, such as mortgages, bank loans, costs, and any other obligations. They're usually divided into current and long-term liabilities. Liabilities are classified as current or long-term, depending on how long you will take to pay off. Current liabilities are those due during the year, while long-term liabilities are any debts that aren't due within a year. A current liability is a debt that will need to be paid within the year. These include payroll expenses, rent and utilities, debt financing, accounts payable, accrued expenses. Long-term liabilities are anything other than the immediate or current obligations or debts that will not be paid within a year, such as leases, loans, bonds due, pension provision, deferred tax liabilities. Take a loan, for example. The stated term of repayment is less than 1 year if you must repay it in that time frame. It's considered a long-term liability if it has to be repaid beyond a year. Shareholder equity. Shareholder equity is the total amount of money that a company's owner would receive if all of the business assets were sold and all of the debts were paid off. It doesn't include retained earnings or the money set aside to pay off debt or reinvest in operations, which are excluded. Investors who are evaluating a company's financial performance can benefit from understanding the owner's equity on the balance sheet. The value of the shareholder's equity rises as sales climb. The greater a small firm's cash reserves, the larger its financial cushion is. Why does the balance sheet matter? Despite popular belief, small company business owners may not believe they require balance statements. There are several reasons why these financial papers are so essential. For one thing, balance sheets show you what your account receivables are if you sell a service or product on credit, including all of the obligations, giving a glimpse into how your company is progressing. A balance sheet also allows you to compare your company's statistics with those of comparable firms. It's also useful when evaluating whether or not you need to take on additional debt to expand your business or decrease the interest rate on your existing debt. Special points to note. Information on assets, obligations, and stockholder equity may be found on a company's balance sheet. The assets should always equal the liabilities and stockholder equity. As a result, the term balance sheet is derived from this fact. Data loss, incorrect or out-of-date data, inventory discrepancies, exchange rate mistakes, and miscalculations are all possibilities if the total does not balance. The breakdown of a company's finances is broken down into numerous smaller accounts in each category. These accounts differ widely by industry, and the same term may have diverse connotations depending on the business's nature. Limitations of balance sheets. Although the balance sheet is useful for investors and analysis, there are certain drawbacks. Because it's a one-time snapshot of reality, it may only compare today's figures to those from a single point in time in the past. Because it is permanent, many financial ratios use data from both the balance sheet and the more dynamic income statement and statement of cash flows to provide a more accurate picture of a firm's financial status. The numbers posted to a balance sheet by different accounting systems and methods of dealing with depreciation and stocks will differ. As a result, managers have some leeway to manipulate the figures to make them appear better. Pay close attention to the financial statement's footnotes to discover which accounting systems are being utilized to spot red flags. Who prepares the balance sheet? Depending on the firm, various parties may be in charge of preparing the balance sheet. The balance sheet for a small privately held businesses might be prepared by the owner or by a company bookkeeper. It may be handled internally and then subjected to external audit. Companies with a public listing, on the other hand, must obtain external audits by public accountants and ensure their books are kept to a much higher level. Last word. The balance sheet is a financial statement that shows the assets and liabilities of a firm at a glance. Users may use the balance sheet to determine if the company has a positive net worth, whether it has enough cash and short-term assets to meet its obligations, and whether it is highly in debt in comparison with its peers. The information revealed in a firm's balance sheet is critical for a business leader, regulator, or prospective investor to comprehend. This knowledge might be difficult to recognize if you don't have it, showing why understanding how to read and interpret a balance sheet is an essential skill for anyone interested in business. So did you think we explained everything? Let us know in the comments below what you would like to know more about.